Stop, right now. I need you to take your eyes off the silver chart, just for 30 seconds. I know exactly what you're seeing. $73. $73 and a few cents on Wednesday afternoon. Your portfolio just did something it has never done before. And you're sitting there, refreshing Kitco like a kid waiting for Christmas morning. I get that feeling. I really do. But listen to me this once, don't celebrate yet. Not because you're wrong, but because you might be looking at the wrong thing. Because what I'm about to show you is not a number, not a breakout. It's a piece of data that might be the most terrifying thing I've seen in my entire career. And I say that after many years in this market. I've been sitting in front of these screens since 2008. I watched Lehman Brothers fall in real time. I saw Bear Stearns get completely swallowed on a Sunday night the market will never forget. So understand this, but what just happened this morning around 11:45 a.m. Eastern Time on a Wednesday in March 2026 makes all of those moments look like a rehearsal, not the main event, just the warm-up. Because this is the main event. This is the crime scene. And the most dangerous part isn't what just happened. It's that no one is talking about it. Not on CNBC, not on Bloomberg, no one. Because if they looked straight into the camera and said what I'm about to tell you, this entire structure would start to collapse. The illusion just broke, not gradually but instantly. Every dollar you hold, every bond in your retirement fund, every mortgage payment you make, all of it is built on trust, and today, that trust was rejected. While you see silver pushing past $73 and gold breaking above $4,580 as if there's no resistance, beneath the surface, the U.S. Treasury brought $69 billion of debt to market, and the world said no. Not weak, not slow, failure. And that's the real reason, not retail, not social media. This is large-scale capital exiting bonds and moving into what cannot be printed physical gold and silver. Real money. Money that has survived for thousands of years. Meanwhile, you're being told to stay calm, sit still. But if this is a theater on fire, the exits are getting narrower. Every day, the U.S. borrows another $5.7 billion. Every year, it needs $9 to $10 trillion just to sustain the system. And today, the market is saying, we don't believe anymore. This isn't opinion, this is data. And the bond market is screaming the truth. Listen carefully. If you think things are already bad, this is where it goes deeper. In any auction, the tail reveals the truth. When yields come in higher than expected, buyers are demanding extra compensation for risk. Today's tail hit 4.2 basis points, 5 times normal, a rare 5 sigma event. History shows the pattern. In 2011, when Standard & Poor's downgraded U.S. debt, gold surged. In 2019, the repo market froze, forcing emergency action from the Federal Reserve. In 2020, massive money printing followed to stabilize the system. Every time the bond market breaks, precious metals rise. But this time is different. The Federal Reserve can't easily step in. Inflation is already at dangerous levels. If they print, the dollar weakens sharply. If they don't, the system absorbs extreme pressure. They're trapped. And the market knows it. Silver knows it. Gold knows it. Institutions know it. Only those still believing everything is fine haven't seen it yet. Because in this system, nothing is random. Everything is connected. And the thread being pulled is oil. Everything you buy runs on diesel, so when oil doubles, inflation doesn't stay at 7.5%, it spreads system-wide. A jump from $88 to $170, minus 93%, can translate with a 3 to 4x multiplier into roughly 22 to 30% CPI pressure over the next 6 to 12 months. Add that to the current 4.8% baseline, and you're no longer talking about inflation. You're talking about 10%, 12% levels last seen in the era of Paul Volcker. Now put yourself in the position of BlackRock, PIMCO, or Vanguard. Would you lock capital at a 4.9% yield when inflation is running at 8 to 10%? No. That's a guaranteed loss. Deeply negative real yields. So capital exits bonds. It doesn't disappear, it transforms into gold, into silver, into commodities. That's why silver jumped from $68 to $73 in a matter of hours, not retail. Institutional capital, leaving a burning building, they're climbing into lifeboats. And those lifeboats are made of metal. So the question is, do you still trust the system, or are you moving with the flow of capital? If you want to understand what's really happening, look at the premiums. Dealers like APMEX, JM Bullion, and SD Bullion are running low on inventory. American Silver Eagles are carrying premiums of $8, $10, roughly 12 to 14%. The paper price says $73, but the real price is $83, $85. That gap is the distance between the system and reality, and this is where things become dangerous. When bond auctions fail, yields must rise. There's no alternative. Bond prices fall, yields rise. Basic mechanics, but for banks, that's a disaster. They hold bonds as safe assets, but as yields rise, the value of those holdings collapses. You saw this in 2023 with Silicon Valley Bank, and now unrealized losses are back over $750 billion, larger than before. All it takes is one headline, one sign of weakness, and deposit outflows begin again. The dominoes start to fall. And this time, the Federal Deposit Insurance Corporation doesn't have the same capacity to backstop the system. The Federal Reserve will be forced to choose, print or let the system break. This is no longer a cycle. This is a breaking point. The debt-to-GDP ratio has moved from 64% in 2008 to over 127% today. You've crossed the line that Carmen Reinhart and Kenneth Rogoff described as the point of no return. From here, the question is no longer if a crisis happens, but when. And the bond market just gave its answer. Now look at the real system, the repo market. This is the plumbing that keeps everything running. If repo stops, ATMs shut down, transfers freeze, the system locks up. But when yields rise after a failed auction, bond prices fall, and collateral loses value. Margin calls begin. Institutions are forced to either post more collateral or liquidate. That's the liquidity chain. That's the domino effect. You saw it in 2019. You saw it in 2020. And now it's coming back. The repo market is starting to choke. Overnight rates are edging higher. Spreads are widening. Confidence is fracturing. And beneath it all is rehypothecation, one bond, multiple promises. When prices fall, everyone faces a collateral shortage at the same time. Leverage on top of leverage, a house of cards, and the wind has just picked up. And when gamma flips, the machines won't save you. They'll accelerate. For most of 2026, silver has been locked in a short gamma environment. When price rises, it gets sold. When it falls, it gets supported. Volatility compressed, the market held in place, until the catalyst appeared. The failed $69 billion auction broke that structure. The gamma flip occurred around $71.05 FOUT, and from that moment, everything changed. Market makers shifted into long gamma, buying as price rises, chasing momentum. Algorithms switched from suppression to acceleration. Silver is no longer being traded, it's being hunted. In less than 45 minutes, price surged from $71.05 to $73, a sharp V-shaped move. No sellers. Shorts wiped out. I estimate 50,000 to 70,000 short contracts were forced to cover, equivalent to roughly 250 to 350 million ounces of paper silver, in a single day when physical metal is already scarce. And that's the critical point. COMEX has only about 72 million ounces of deliverable silver left, roughly $3.6 billion. A number so small, it's almost insignificant, while capital is accelerating. That 72 million ounces of physical silver is so small, it's almost non-existent. It's smaller than the market cap of a mid-sized tech stock, a rounding error in a $36.5 trillion debt world. And yet it's backing the entire global silver market. Do the math. Roughly 140,000 COMEX contracts, each representing 5,000 ounces, that's about 700 million ounces on paper, against just 72 million ounces of real metal. Nearly 10 to 1. For every 1 ounce of physical, there are 10 ounces of promises. And if just 10% demand delivery? The system has two options: declare force majeure or push prices high enough to force metal back into the market. And at $73, no one is selling. At $80, still no supply. At $90, Maybe it begins at $100, possibly. But the message is clear. The scarcity is real. This is no longer a market. This is a leveraged paper casino, sitting on top of a very small amount of metal, and the game is nearing its end. But this isn't just about silver. This is geopolitics. While the U.S. sinks deeper into debt and struggles through failed auctions, BRICS nations from China to Saudi Arabia are accumulating gold at an unprecedented pace. China alone may be buying 50 to 100 tons per month off the books. Actual reserves could be far higher than reported. They're not buying randomly. They're waiting. Waiting for the moment when confidence in U.S. treasuries breaks. Because since 1971, after the Nixon shock, the United States has operated under a privilege, borrowing in its own currency. But that privilege always had a cost. And that cost is arriving. Not gradually, but right now. The consequences never disappear, they're only delayed. And now, they've arrived. BRICS nations are building a new system. SWIFT is being bypassed. Russia and China are settling trade in local currencies. Saudi Arabia, a pillar of the petrodollar, is selling oil in yuan. The petrodollar doesn't die overnight, but it's clearly weakening, and the alternative: gold. No counterparty risk, no printing press, no one's liability. Under Basel III, gold is treated as a Tier 1 asset. Central banks are telling you something, not with words, but with actions. They're buying over 1,400 tons per year. They're preparing for a post-dollar world. Meanwhile, the bond market is shaking. The Federal Reserve is trapped. Oil is pushing inflation higher. COMEX is running nearly 10-to-1 leverage, and silver is approaching a breakout point. $78.88 is the next wall. Break that and there's little resistance left. $100 is no longer a forecast, it's a probability. Because gamma has flipped. Algorithms are accelerating, shorts are being squeezed. Physical metal is running thin, and this time, no one is coming to rescue the bond market. The world just sent a message. We will not fund your debt anymore. This isn't a trade. This is a system transition. You can move ahead of it, or get carried by it. There is no middle ground.